Welcome to this week's financial report with Quiver Financial. I'm Colby McFadden, and it's the start of March, and financial markets are beginning the ides of spring with some volatility. Stock markets are in correction mode, led by sell-offs in the Mag 7, the tech sector, and momentum names, while uncertainty around tariffs lead all the headlines. Is this the end of the bull market or just the run-of-the-mill correction with a rotation of leadership? I'm going to show you what we're seeing in markets, what we're doing within the equity markets, while I answer the number one question that we've received from our clients this week, and we've received it in a lot of different tones. Is Trump messing up my investment portfolio? So this week we're going to deviate from our normal plan because, as most of you who've been watching for a while probably know, that we typically talk about the stock market, interest rates, oil and energy, gold and metals, those types of things. And because those are the 5 areas of markets that have the greatest amount of influence on your net worth. So that's why we talk about them week in and week out. This week, however, I wanted to deviate from that because really from last week's show, nothing has changed. If somebody asked me what happened this week, I would say, you know what? Go back to last week's show, Singing with the Stones, and thank you to everybody who did not make fun of me for trying to sing. Don't worry, I'm not going to be on American Idol anytime soon. I'll probably never try and sing online ever again. But if you want to get an update on what's going on in the stock market, metals, oil, and energy, look at last week's report, because this week, pretty much everything we talked about held. What I really want to focus on this week is the big question that we've been getting from everybody: is Trump messing up my portfolio? Because this week, the whole tariff headline really hit the crescendo mark, and it seemed to roil markets because everything on CNBC and Fox Business News seemed to talk about the uncertainty of the tariffs causing a sell-off in the markets. So I really wanted to talk about this thing: is what's going on with the tariffs, and why is this their emphasis on the border and fentanyl and drug trade when it comes to tariffs. And it really goes back in history because in 1994, we figured most of this stuff out with Mexico and Canada. We had a trade agreement, but Trump in his first administration had been very vocal that he never liked that deal. And quite honestly, a lot of things have changed over the time with China moving manufacturing from there, and many other companies and countries doing this to circumvent different things as far as future tariffs and past tariffs. So in 2020, Trump renegotiated NAFTA. It became what's known as the USMCA, the United States, Mexico, Canada Agreement. I know they didn't have a marketing department, creative fun, acronym like DOGE or anything like that. But in July 2020, they cut a new deal. And what you have to understand is this emphasis around the border and the drug trade really is nothing more than allowing Trump to have certain leverage because he's enacted emergency powers using that as an excuse. And the reason that's important is because come next year, come 2026, there's certain parts of the USMCA agreement that become set in stone. They'll be there for 10 years, and it means that the current tariffs would become illegal. So Trump knows that this is his moment to use a leverage point, these emergency powers around the border, while he can. And essentially what he's doing is he's never letting a crisis go without finding an opportunity, even though it's a self-created crisis. At the end of the day, what's happening around tariffs and the conversation of emphasis around the border and drugs leads me to believe that this is something that is temporary. So when it comes to the question, is Trump messing up my portfolio? The answer is maybe, maybe not. If these tariffs, if what he's doing is a temporary move, a leverage negotiating point, then they may have no effect on your long-term investment thesis. And maybe They just created a great buying opportunity. So it really depends on what your time frame is. If you're trying to make money this week, yeah, maybe it's making it hard for you. However, if you've been sitting on the sidelines, if you had money, in cash that you wanted to put to work, maybe what's happening here opens up a buying opportunity. So it depends on your time frame, your risk tolerance, and where you're allocated currently. How are you diversified? Because since this has all started, there's some big recent losers, which has been in the tech sector, the momentum names. Essentially, the generals have been taken out and shot. Now, in the big picture, I'm going to show you a chart in like 2 slides. In the big picture, all that's happened there is these names have given up a lot of the growth that they got right after the election. So there's been this Trump bump and now a slump. So it hasn't been materially damaging to the overall market. So maybe it's creating a buying opportunity, because at the same time, while these areas have sold off, there's been some winners from this, because the traded REITs have done quite well. We talked about that in our last videos. Utilities have held up well. Metals have done quite well. So there are quite a few areas within the market that seems that as money has left the tech sector, it's cycled over and rotated into traded REITs, utilities, metals, other areas that pay dividends, have had higher value. So it's really been this reversal of fortune for people who had a diversified portfolio, because last year, most people got punished for having a diversified portfolio. Diversified portfolios really underperformed last year when there was only 5 or 6 stocks pushing everything higher. Now that we've come into 2025, that has changed, and it's a good time to have a diversified portfolio, because there are more sectors of the market that are starting to attract capital as it leaves some of these generals, the tech names and the momentum names. So I see that as very healthy. I think that if you're a prudent investor, if you're an income seeker, if you're a value investor, the market becomes much more interesting. So let's talk about some of the levels that you should be watching if you're interested in increasing your equity exposure. So we, like I mentioned before, we typically talk about stocks, oil, energy, metals. Go back to last week's show if you want to get an update on that, because right now I'm only going to focus on the equity markets, because for the last few weeks, we've talked about the equity markets are ripe for a correction. We have a very clear 5-wave Elliott wave pattern. When you get to the end of the 5th wave, you can expect a correction at best, at worst, a pretty nasty bear market. So we've been expressing caution for everybody, because at any moment the music could stop. And I know we're very enthusiastic about deregulation and the future of policies that could be more growth oriented, but also realize right now in the short term, there's a lot of austerity that's happening, that's increasing layoffs while we have interest rates that are still higher than they were a few years ago. So there's still a lot of factors out there that we've got to watch, that if and when this equity market goes through a correction like is happening now, we have to be aware that it may not just be a short-term thing. So you've got to now have a longer-term game plan in equities in order to manage the risk. One of the big evidences of that is that the little guys are all in. If you've ever heard the theory of be greedy when everybody else is fearful, and be fearful when everybody else is greedy, well, realize if all the small speculators are in the market, then pretty much everybody's greedy. So we should be aware of that. Doesn't mean the market can't keep going higher, but it means that as markets go through corrections like now, we have to be more diligent in paying attention. So what we do at Quiver is we tighten up the grip on our bat, and we start managing our risk and equity markets week by week. And last week, we shared with everybody that there was this level at 6,000 and 5,800. Basically, between 5,800 and 6,000 was what we was calling our warning zone, that if we broke down into that, that we would now be in correction territory, and to manage risk, we would want to see how that develops and watch the next bounce. Now, we pointed out last week that the Mag 7 names, as of the end of last week, had already seen a pretty decent correction. And on Friday of last week, the market bounced. You can see that right here. So now what happened this week? Well, after that bounce, we cratered and broke through that 5,800 level and now are approaching 5,600. And as I speak and markets are closing, it looks like we're holding that level. So what should you do now? If you have money sitting on the sidelines and you wanted to get into the stock market, or if you got into the stock market on this Trump bump, and now you're getting a little anxious that maybe you got in too early, what should you do? Well, what I'm going to be watching is the first order of business is the market's got to get out of this crash channel that I drew here. So I would love to see that 56 level hold and break out of this crash channel. If that happened, then I would feel pretty good and confident that number two is happening, which is 5,600 held support. Because if 5,600 breaks, your next level of support is 5,400. And then you could go all the way down to 5,200, where you could find some really good support. So there's quite a few levels here to watch. This first one is the 5,600 level. So if we can bounce there and get out of this crash channel, then I'm going to see how that bounce develops. And if it turns into only a 3-wave rise, let's say maybe it rises to 59 to 6,000 and then roll over and fail, then I'm going to be, start to announce bear market could be in mode, bull market could be over. Not saying that's going to happen now, but those are the signs that I'm going to be watching for to be able to be ahead of the next curve in equities. If 5,600 holds, there's a lot of interesting things happening. Last week, I showed to you guys that things like Amazon, Microsoft, Google, they all had corrected pretty significantly. This week, they went a little bit lower. They're all at levels of support, so it'd be interesting to see if they hold here, especially when sentiment has gotten so negative. One other I pointed out last week is utilities. It sold off a little bit deeper this week, but now it's bounced off its 200-day moving average. So that looks really interesting because relative to all the other sectors out there, utilities have had great performance. So these are just some things that I'm watching. And what I'm realizing is that most of this current correction has been in tech and that overvalued area that earlier this year, we were saying we were light within our portfolios. So that has opened up an opportunity for us at Quiver to start to now nibble away at buying a little more of these names that we were waiting for this kind of correction. So back to the question, is Trump messing up your portfolio? Kind of depends. If you're like us at Quiver, where we were waiting for this, it's creating an opportunity. So now we just have to watch what happens on the rebound in the market. So if you're out there wondering, well, hey, is this a buying opportunity? If you have money on the sidelines, what are some areas of the market that you can look at that might have a little bit stronger relative strength? The things that may want to be on your radar are things like metals and miners. They continue to perform well and their charts look good. Utilities and energy. Utilities, the charts look a lot better than energy. However, they're both big value plays with a lot of dividend payers in there. And just between metals and energy and utilities, there's a lot of companies that could be on your radar. Surprisingly, healthcare has held together really well the last couple of weeks. It seems that it had the biggest sell-off right when everybody realized that RFK was coming around. But since then, it's had a rebound, and it seems that as money has been leaving the Mag 7 and all the big names, that healthcare has been a benefactor of that. And then the traded REITs, we've been talking about traded REITs for weeks, really since the start of the year, really since last October, and they continue to pay a great income and their trends continue to look pretty darn good here. And that's really the story of interest rates. If they stay between 4 and 5%, we like that area for certain investors. Consumer staples this week did incredibly well as the market sold off. So you can really see where money has been rotating to the more defensive names, even, and you can see that that's kind of that move of, are we going into time of stagflation or recession? Because all of these areas that are here on the screen, even aerospace and defense, these are the types of areas or market sectors that you'd expect to see be stronger while you're in times of stagflation. So I think that's going to be a big subject of conversation that we're going to see over the next few weeks, is more and more of the news reporting that, hey, are we going into stagflation? So I think next week we'll talk a lot about how to position a portfolio for the times that you're in stagflation, like the 1970s type of era that we've been hypothesizing we could be in here in the 2020s. So look for that next week. If any of this was helpful for you, please give us a like and subscribe. And until next week, folks, take care, and hopefully we get a great weekend of good spring weather.